Frederic Neumann is co-head of Asian Economic Research at HSBC and joins us now. Great to see you, Fred. China's economy probably grew the least in almost 2 years. Prices climbed the most in 3 years. How much of a dilemma is that for Wen Jiabao? Why can he not square that circle?
It's a big challenge. The Chinese economy is actually running out of excess capacity. So running at 9 to 9.5% growth does stoke inflationary pressures. The trend growth pace in China is actually coming down. That is, China needs to engineer a soft landing to squeeze out inflationary pressures. And that's what they've done with interest rate hikes.
So have we peaked the inflation, or do you think there's still yet more to come?
I think we've peaked. This was almost anticipated that we had this very elevated inflation reading, but there are signs that inflationary pressures are already starting to ease. If you look at the PMIs, for example, the input and output price component coming down very rapidly in the month of June, and that usually leads CPI. So we think by year end, you might see inflation again down to 4%.
So what does that mean for interest rate hikes and raises to reserve requirements?
Well, we're probably done on the interest rate front, because that's probably the harshest measure they can apply. But there's still a need to manage liquidity, so they might raise another reserve requirement ratios by another 50 to 100 basis points. But it's also interesting that at the micro level, they're starting to impose, again, stimulative policy. So they're tightening at a macro level to manage liquidity, but they're also rolling out, again, measures to support growth. So with that inflection point where they're feeling
talking
comfortable.
About government projects?
Well, one is the public housing construction, for example, which they have reiterated in the last few weeks that they will start this on schedule, and they've made it easier for local governments to finance these. But there are other measures as well. For example, lending to SMEs. These restrictions are gradually being removed. There's now talk about car sale restrictions being lifted as well, just to support growth. So at the micro level, they're starting to stimulate growth.
And where does this leave the currency, the yuan? Surely a higher currency would actually help the imported inflation that is causing so much problems.
Yeah, but at the same time, you have very worrying news in terms of external demand. Yet the non-farm payroll numbers out on Friday in the U.S., for example. So my view would be more that the concerns over export growth are going to trump the concerns over inflation. So that perhaps, if anything, the pace of appreciation might slow just a little bit, because we are seeing slower export growth.
And we did see that in this latest set of figures as well. Now, I had a guest on earlier who was talking about banks and the risks to banks and people taking their money out of banks because they're not getting much in terms of money back on they're not getting enough back, they're not getting enough of a return. And he was suggesting that was a big concern.
Well, in terms of depositors taking money out of the bank, it's true that the real interest rate is negative, so that you're not getting much in terms of returns. But at the same time, you don't have many alternatives in China. And this is, so in some sense, you have the deposits are being captured by banks. And I think that's not going to go away anytime soon, because you can't take money outside of China legally. You cannot invest in a lot of alternative investments. So to some extent, savers are captured in China. And I'm not terribly worried about a drain of deposits in the Chinese banking system.
In a way, Wen Jiabao is running out of options, isn't he?
Well, well, to extent, I would actually say that what we're seeing now is exactly what the Chinese government has engineered. It is a gradual slowdown in terms of growth. Inflation was always going to be a problem this year because we saw massive lending expansion last year, for example. And so the tightening measures that were rolled out are finally getting traction. And therefore, I would actually think that it's all playing out as intended.
Sorry.
I was just saying, does this mean that China is going to hold up the rest of the world here because we're seeing this slowdown in the developed markets?
Well, I think that's the problem. China can't carry the world on its shoulders. It's a very exciting economy. It's growing very rapidly, but it's not yet big enough to really support growth if we indeed have a hard landing in the U.S., if in Europe we have peripheral challenges continue to fester. So I think we're putting a bit too much faith into China. But yes, in terms of market sentiment, it is important that we only have a soft landing in China.
And inflation predictions?
Coming down in China, already on a sequential basis, food prices are starting to ease again. And also what we're seeing from the companies in China, they're reporting much less severe price pressures. And that, therefore, 4% by the end of the year, inflation rate, that should be roughly
just
on
bang
target.
in line with what they'd like to see. All right, Frederic Neumann, from HSBC. Thanks very much for coming to see us in London.
Great to see you.